if you look at this path to 10 to 100 baggers, basically there are, let's say, there could be more, but there are basically five ways you could get there, right? So one is you could buy these, what I would call focused mouse traps. These are very narrowly focused players with long runways, like, Moutai is one in China, which has just opened its first store in China, McDonald's, and so on. You could also get there with great capital allocators, kind of like Berkshire Hathaway or Danaher or Exorient, which is based in Europe. Or you could also get there by investing in the Uber cannibals. So the Uber cannibals are companies that are very focused on stock buybacks, and they end up buying back, large portions. So, for example, a company like NVR, which is a US based home builder, from 1996, when they started doing stock buybacks, until now, 2020, they bought back something like 82% of their shares outstanding. So just 18% of the shares outstanding are left. And NVR has delivered, I think, it's more than a 70 bagger in that period. The stock has gone up more than 70 times. In fact, in the last 20 years, it's gone up more than 55 times. And the business actually has not grown that much. All they've done is they've taken all their free cash flow every year and pounded it into buybacks. AutoZone is another one. These are not rapidly growing businesses, but again, similar story. And then one that happened in the 60s and 70s was Teledyne with Henry Singleton. And in fact, there's a book that you might enjoy called Distant Force. So Teledyne issued a lot of stock in the 1960s when it acquired almost 150 businesses when the market gave it a very high multiple. And then in the 1970s, when the US equity markets were very cheap and collapsed, and Teledyne was trading at, maybe single digit multiple of earnings, Henry Singleton bought back more than 80% of the stock. And again, in the case of Teledyne, they delivered about 125 times the value from 1960 to 1980. It was about 125x. And then you can also get to multi-baggers by buying, deeply undervalued players, companies that have gone down a lot. I've done some of that, and these are some companies I've invested in. Tech Cominco was one I bought right during the financial crisis in '09. It became a 10 bagger. Fiat Chrysler in 2012, it also did very well, and then Ray Industries more recently. But the one I want to talk about today, which is part of the renaissance this year, is the spawners. And the spawners are companies that continuously spawn related and unrelated businesses. Very few companies have the DNA to be great spawners. And we'll drill down a little bit on the different kinds of spawners. And basically, these are companies that have a deep conviction of, and really it's part of the DNA, to keep adding and incubating new businesses that have the potential to be massive growth engines. They expect many of these things to fail, and they take failure in their stride. And a good example is the Bezos quote. It says, "Staying in day one requires you to experiment patiently, accept failures, plant seeds, protect saplings, and double down when you see customer delight." And Amazon is one of the great spawner companies that we have. Spawning also has a lot of advantages, in fact, a lot more advantages than cannibals, because cannibals have to pay tax on their earnings, and then they can use the money to buy back shares. In the case of spawning, what you're doing is you're basically reducing your net income, which basically then reduces your taxes. So in effect, you're getting a interest-free loan from the government on very easy terms, payable when able. So for example, through most of its history, Amazon has hardly reported much in earnings. Their core businesses were quite profitable, but they were taking all the cash flows and continuously investing them into new bets. 30-40% of the money that they were investing would have gone to the government if they didn't do that. So it's a very capital efficient way to do this if you are good at spawning. So there are different kinds of spawners, and I came up with these different spawners on my own. And they may be more, but I think this captures a lot of it. So adjacent spawners are companies that create businesses that are close to the business they already are in. They kind of are looking at, like Amazon when they started was only selling books, and then they started adding more categories. They started selling music, and they kept adding more categories. So it didn't require a lot of change in the business. That's what I would call adjacent spawners. Embryonic spawners are companies that acquire businesses and then nurture them into much larger enterprises. And for example, through most of its history, Microsoft has not been a acquisitive company. It basically kind of grew its businesses organically, but they bought what we know as PowerPoint as they actually bought the company, and then they changed the name to PowerPoint and then made it part of Office. So that was an example of an embryonic spawner. Cloner spawners are not innovative. They just copy successful products. Microsoft is a good example of cloner spawners. And then non-adjacent spawners create or buy new unrelated business areas. So for example, recently during the pandemic, BYD went into manufacturing of N95 masks. And that business has nothing to do with what one would consider the core competencies of BYD. But Cheng-Fu Wang has never been limited by core competencies. He's repeatedly gone into businesses. When you would look at him from the outside, you would say he has no competence in this. But he's repeatedly shown that he can get competence. So they entered the car business and they were able to make that quite a success, which is difficult. They entered the N95 mask business, and I'm pretty sure they've, if they haven't already turned into business, they will. And then Apex Spawner is a business which uses all four of these strategies and such. And generally speaking, the reason I'm giving you these spawner categories is Apex spawners are very rare, and Apex spawners can be amongst the very best investments you can make because they've got so many different ways to nirvana. They've got, it's kind of a Swiss Army knife. They can bring out different tools, and they're really good at all of the above. So let's look at some of these spawners with some examples. So adjacent spawns, we can look at Starbucks. They created the consumer packaged goods, the Frappuccino bottles, which first they did a deal with Pepsi, which they sold in supermarkets. They created a coffee machine. I think now in China, they have opened the Starbucks Reserve stores, which have done really well. And they're also experimenting with alcohol, alcohol-infused drinks and such, which is quite a significant departure from what is traditionally a Starbucks store. But they're doing all these spawns, and it extends the runway. Facebook has been really good at embryonic spawning, where they bought Instagram and they bought WhatsApp, they bought Oculus, and they have taken these embryonic businesses and they've created pretty significant value and growth. The same with what Google did with YouTube, very significant growth, or what Google did with Android, which is also a company they bought. Microsoft doesn't do much embryonic spawning, but like I told you, they bought a company named Forethought and then later renamed it as PowerPoint. But they are very good at cloner spawning. Windows from the Mac, Word and Excel from WordPerfect and Lotus, Explorer from Netscape, Surface from the iPod, Azure from Google and Amazon Web Services, and Teams from Slate and such. Apex spawners, I told you, they're very rare. And if you can spot an Apex spawner, early in its journey, it can be very, very attractive and can give you a pretty long runway. Because what happens is that, Amazon started with just a bookstore. It's like all eggs in one basket. And but as they start doing more things, because these are mostly digital bets, the return on capital is extremely high, and so it can also tolerate a lot of failure. So they've done a very good job with obviously the adjacent spawning, embryonic spawning, like they bought Zappos and Whole Foods. Cloner, some of these cloners didn't work. Like they came up with the Fire Phone, which they offered for I think 99 cents, but they couldn't get any traction, and then the Fire Phone was buried, and they moved on. And then they've done non-adjacent spawning, like Amazon Web Services is quite a departure from their typical retail, and it's done very well. And Kindle was quite a departure because it required quite a few different competencies. Similarly, Alphabet has done all of the above. They've done a lot of embryonic stuff. They've also done a lot of non-adjacent stuff where they've gone into things like Google Fiber and so on. Alibaba, you guys are very familiar with, Alipay, with the adjacent spawning, and they've done a number of things on the embryonic front, cloners, and then even the non-adjacent with the Alibaba Cloud and AliTrip. Berkshire Hathaway Reinsurance was a spawn that Ajit Jain did for them, probably worth over 100 billion in value that business has created for Berkshire from scratch, where they pretty much didn't have to put up a lot of risk capital to make that happen. Embryonic, they bought Geico, and it had been around for a long time, but it was pretty small, less than 2% market share of the US insurance business, and now it's more than 10%. Mid American Energy has grown a lot. Nebraska Furniture Mart has grown a lot. They've started some digital insurance companies recently, 3 Insurance and Buy Burke. These are cutting out the agent. And so they've cloned some of the other players like I think Wilcox and so on. And then Tencent again has done a number of things on all of the above. You guys use WeChat, the games, future mobility. I mean, and Baidu is very similar. Again, they've kind of done all of the above, and these have been tremendous home runs, especially if you got them early. One spawner I just want to talk about, Kotak Mahindra is a company in India. I actually was smart enough to make a very small investment in this company in 1995. And I was also very dumb where I sold the company in 2000 with almost no returns. I'll come back to this slide in a second, but I just want to show you kind of what happened with Kotak. So if you see Kotak, so in 1995, I invested a small amount of money in India, maybe around $25,000 personally. I was going to invest in 3 businesses in India at the time, which I thought they all had huge runways. And Kotak was actually my broker that I had opened the account with. In dealing with them, I was just really, really impressed with the quality of the people I was dealing with. So pretty much at the last minute, I said, out of this 25,000, I'll put 3,000 or so into Kotak because they were a listed company and such. And what happened with me with my 25,000 investment is one company that I'd invested about 10,000 in was 140x. So it became 1.4 million in about 5 years. And I was smart enough to exit that. I was part of the .com boom. And then I thought, the other 3 companies had not done much over that period of time. So I said, okay, you hit the big time with one, it doesn't really matter. For no good reason, really, I sold the other 3 companies at 2,000, including Kotak. And of course, if I just kept the $3,000 in Kotak, I would have about 600,000 today. But just to go back to Kotak, they were very small broker. Goldman Sachs at the time had taken a 20% stake in them because, again, I think like me, they were very impressed with them. And the key thing that happened to them was in 2003. In 2003, they got a banking license, and in India, it's really hard to get banking licenses. I mean, the Reserve Bank has issued very few banking licenses to private banks. And Kotak today has become one of the largest private banks in India. They've executed really well, and that's where the bulk of their upside has come from. But the company has spawned many adjacent businesses, and they've even acquired a few businesses and gone from there. I told you most companies do not have the DNA to do spawning. Spawning is an unusual kind of DNA, especially the successful spawners. So, for example, some of you may be familiar with Chipotle, which is a very successful Mexican chain here in the US. I don't think they've entered China yet. But McDonald's actually spotted Chipotle when they just had about 20 or 30 stores in Denver, in Colorado. And I think they took a 20 or 30% stake in Chipotle. And then later, McDonald's felt that it was a distraction for them to own this business. So Chipotle had grown a lot. It had gone from 20, 30 stores to a few hundred stores. McDonald's had done really well with the investment. They could clearly see that there was a long runway ahead, but they felt it was a distraction. So they divested that stake. And of course, Chipotle has been a major home run for them. So McDonald's kind of is, you can say, the kind of company where they, from a DNA perspective, are all in on the McDonald's brand, and they've innovated. They've innovated inside McDonald's. So, for example, breakfast was an innovation, drive-through was an innovation, the Big Mac was a big innovation. The McMuffin, and most of these innovations came from their franchisees. But McDonald's basically is a company that is not. It's kind of, you can say, the opposite of Alibaba or an Amazon. They don't do very well having multiple brands or businesses. They just want to be all in on McDonald's and do that really well, and that works well for them. So they're classically a non-spawner. Another one is Ford. So Ford had many, many years ago invested and bought Land Rover and Jaguar. And then when Alan Mulally came in as the CEO, he felt traction because he noticed that most of the Ford executives were driving Land Rovers and Jaguars and not really driving Ford cars because they were getting employee discounts on all the brands. So he really wanted to focus only on the Ford brand. So in 2009, he got rid of these two companies. And actually, they're decent companies. They have very strong brands built over probably close to a century or more. And so most businesses are not good at spawning. And in fact, these are two examples of businesses that actually got rid of what would have been adjacent businesses just because they felt it was a distraction. Some other examples of non-spawners, Costco is a great example of a non-spawner. It executes really well. I mean, if you compare Costco to Walmart, Walmart has spawned quite a bit. They have a number of formats of stores and operations globally, and they have a number of formats even in the US. Moutai is also, you can say, very singularly focused in and around the core Moutai brand and such. So one of the things that spawning does, which makes it very good from an investing point of view, is capitalism is very brutal. So every company is eventually going to die. It's just the nature of capitalism. Even the strongest businesses, there will come a time when Alibaba will not be around, Amazon will not be around, because if you just study the history of businesses that were dominant 50 years ago, 100 years ago, they're not with us today. GE and IBM were good, strong spawners. If they had not done spawning, they would have died a long time ago. So spawning extended the runway of these companies. Microsoft originally was just making compilers. They had a basic compiler. They were a compiler company. From there, they went into becoming a operating system company. They actually bought the company that became MS-DOS. And it would just be a shadow of itself without spawning, because all these things that they've done is all add-ons to the core business. And so spawning basically keeps the mothership young and healthy. So it has a lot of advantages, including I already told you about the tax advantages. Some rules on spawning investing is that you can probably study these statistics in China, but if I look at the United States in the last 20 years, there were 3,700 IPOs in the US in the last 20 years. Only 9 businesses with an IPO in the last 20 years have exceeded 100 million market cap now. If you just make a simple assumption that a business that you invest in will never get to more than a 50 billion market cap, if you just made that assumption, then by inversion, you get a couple of rules. So if you want a 10 bagger, 10 times your money out of a business, it means you can't really buy a business which is more than a 5 billion market cap. And if you want to buy a 100 bagger, then you really can't buy a business that has more than a 500 million market cap. Important thing with these 100 baggers and 10 baggers. So if you look at any public company or most public companies, pretty much around the world, almost all of them have been 100 baggers at some point. Most of the 100 bagger is usually captured while they were still private. So once they come public, they may not be small enough where they can go 100 times. But so the earlier you can get to these businesses, the more likely it is that you can get to 10 times your money or 100 times your money. So if we look at a business like Alibaba today, 800 billion market value, can Alibaba be a 100 bagger in 20 years? Anything is possible, but it is probably unlikely, because you're talking about something like $80 trillion. It's a really large number. And we don't even have businesses anywhere in the world that are more than $3 trillion. So, or even much more than $2 trillion. So catching multi-baggers early is important. But also you have to remember that the earlier you go in a company's life, the wider the range of outcomes. So if I invest in a Mautai today, the path is relatively narrow in terms of outcomes. But if I go into a very early stage business, the range can be quite wide. So there's an art and science here in terms of making sure you have enough traction. So my rules, what I call the Pabrai Spawning rules, which I just came up with a few days ago, is make an assumption that no business you invest in will ever exceed a 50 billion market cap. And so if you want to make 10 times your money, you got to buy below 5 billion. If you want to make more than 100 times your money, you've got to buy below 500 million. What I found about spawning is that spawning is not a trait that you can easily screen for automatically. So you can run a screen for low PE, you can run a screen for low price to book, you can run a screen for a lot of quantitative metrics about a company. It is generally, at least from what I have found, it's not obvious what business is a spawner or is not a spawner until you spend at least a little bit of time looking at the business. And once you look at the business with a little bit more detail, then you can get to the nature of the spawning. Are they a non-spawner or are they a spawner? And if they are spawner, how strong a spawner are they? Okay, does it have strong spawning DNA or not? One of the things I want to get to in my portfolio eventually is a portfolio that is only spawners, and ideally a portfolio that is only apex spawners, and ideally a portfolio which is only apex spawners where every company in the portfolio is 100 million market cap. That to me would be the holy grail. So we have to look at, does it have strong spawning DNA? Does it have a great capital allocator running it? And what I found about spawning is that you don't need to make heroic assumptions. Even a 500 million or $300 million business will have enough trademarks in the past from the time they were private and when they were public, which will make it obvious to you that this company has spawning DNA or doesn't have spawning DNA and the nature of that DNA. And so, three businesses in the portfolio that were great spawners, and I think they are all they're all below a billion market cap. And then recently I found a fourth one, which is below 400 million and strong spawning DNA and a very long history. So you could easily tell what's been going on in that business. And of course, the hunt is on